think the biggest thing that investors will have to grapple with this year is this coming head-on collision between government debt and the interest rate level. I can't say that we know how that's going to come out, and nobody does, but that's the problem. And if you take the new administration coming in, a lot of things they want to do, I think, are admirable. But the problem is if you do a lot of those things at the same time with a strong dollar, debt where it is, and rates where they are, you could conceivably really mess up the bond market, which would mess up the stock market. You're going to have to be a little cautious as they come in, because they're going to float all of these things probably in the first 2 or 3 or 4 weeks, float some trial balloons and that kind of thing, and we'll have a little better feel for it. We haven't been able, we buy stocks from the bottom up. We have screens for those, and people don't realize, but really the Mag 7, the big 10 companies that are in the S&P, they all peaked the first week in December. They're not at a new high right now. You'll see them come back on days like today, but generally they've rolled over from their peaks in early December. Will that be the high? I don't know. I do know this, they're still fairly expensive. And for us, we look at companies separately, single by themselves, same way with bonds. So if we see something we like, we'll buy it no matter what the atmosphere. But right now we just don't have that many companies. But I think the macro will be a little confusing because people don't understand what's coming on here with these rates where they are and what's going on with the U.S. government right now.
Well,
if you have a strong dollar, which we've had and continue to have a strong dollar, and then you go into all the countries and put on blanket tariffs, for example, I don't know that they're going to do that. I'm just saying what they mentioned they would do. Then all of a sudden, those two items alone are automatic inflation. Well, that's one side of the equation. The other side right now is the U.S. government has to refinance about $10 trillion just this year. And they have a $7 trillion budget from the continuing resolution, but we've got a shortfall of $1.8 trillion. Now, they were talking about maybe reducing that by $2 trillion. But if you think about it, if you take $2 trillion out of the cost side, okay, not the revenue side, you probably are going to be close to recession, if not automatically in one. If they do $1 trillion, you're still going to have I think you figure about for every $1 trillion, it's about 2.5 points of GDP. So here's what happened. Here's the struggle. They need to refinance, the government, plus they need to do new debt all the time. The new treasurer will have to decide, unlike Janet Yellen, who kept everything really short in T-bills, if they're going to get their finances straight, they're going to have to lock in some longer paper that's like 20, 25, 30 years. And the reason they have to do that is because if you keep having all of this money come due that they kept short term, then you're going to be a prisoner of a rise in rates. And it doesn't work in the government side. And I don't know how they will address all of that, but people need to understand they need to watch a couple of things. Watch the dollar if it stays strong and doesn't weaken. If you put that together with how much debt that has to refinance, and the fact that if you just take the receipts for taxes right now, if you just take the receipts and a little bit of the debt that comes due, use all of that just on the interest. And so we don't have any room here to move, and what happens. And if you look at the 4 things they want to do, which would be lower the corporate income tax, take personal taxes back like they were, don't tax Social Security, and go back with a couple other things. That alone right there, if you don't change anything, that increases your budget deficit by about 30%. Now, it's admirable to try to get these things efficient, but it's probably some pain in the short run for gain in the long run. And that's all I think people need to understand. That was Ronald Reagan, by the way. Lots of pain. He came in January of 81. We had a bear market, lasted all the way to August of 1982. If you look overseas, they're not buying any more bonds. They're at the same level they were, 12 years ago. As far as the bonds they own, they don't buy any new ones particularly. They buy a few to keep, some of them countries do. But on the other hand, a lot of those countries have dollar-denominated debt. So if they get in a situation where the dollar keeps on getting stronger and stronger and we don't pull that dollar back, that means they're having to pay more with their currency on that debt because they're converting to dollars. That's a negative for everybody if they can't change that. But the second part of it is that we have a situation where debt is really constraining. It wasn't like, when he came in 2016, we had a lot less debt to GDP than we do now. Where government debt to GDP is 120% or so. You get to that level, you don't have a lot of moves you can make. So you've got to do some things that would be good for you. It'd be like going to the dentist and, you're going to get a shot. Something's going to happen to you, but in the long run, it's good. It's something like that. I think people just wake up. This is not a time, to me, to be starting some brand new investment program when things are probably as up in the air right now as they've ever been.
Mhm.
I just got these numbers from the Federal Reserve. If you look at, and this was through basically October 1, 24, 79% of all equities, not in the U.S., all equities are owned by people over 55 years old. Now, and a subset of that is 38%. Every stock is owned by people over 70. And what we've mentioned to so many people is if you go through a period like 2000 to 2013 or 1965 to 1983, where nobody makes any money, you don't lose a ton, you don't go anywhere. So inflation eats that dollar amount away and your buying power goes lower and lower and lower. And I'm not certain those people at those ages are ready for a nasty market. I put together a graph last week. It took the last 5 years of the S&P 500, okay, the exact number, total return. And in the sixth year, I said, if you have a 40% sell-off, your compound return goes to 2.8% annual. If you have a 50% sell-off and you're fully invested, it goes to zero. And I know people say, oh, you're crazy. That'll never happen, but they don't know history well enough. It can happen. I would think more likely this year with all this going on in Washington that we would have a different kind of market where we would have 2 or 3 periods where the market really drifts a good bit lower, maybe 20%, 25 points, then goes back up, goes back again. And I have to tell you, the investment community is not used to or doesn't know the fine art of how to trade something. And that's where I think the money will be made, more than just buy and hold like it's been in the last 12 years. If you look at the presidential 4-year situation, you can track this on markets. Typically the first year into the second year, if you're going to have some trouble, it happens in between those times. What happens? Because, you have some trouble stirring. What I told you about Reagan, where he had a lot of stuff he had to fix with it, really, really high inflation. Or look at George W. Bush, where he came into office and after the lawsuit in 2000, didn't realize 18 months later you had 9/11. But even during 2000, the market was already headed down, economy was slowing, rates were going up. So sometimes they do okay and sometimes they don't. 2009 when President Obama came in, we had already had the worst was behind us. So you had a good year in 2009. And so it's a setup. Now, right now, though, here's the thing. We're at all-time highs. We're 22 times forward earnings. And could we go to 25 or 30 times? Yeah, you could. It would be a screaming sell, even more so than it is now. But you just never know how that transpires because you get a lot of different people coming in. Almost everybody is complacent right now. Nobody we see, and we run quite a bit of money, but in talking to other people that are thinking about doing business with us or that sort of thing, they don't see any need at all to cut down their stock exposure. None. And I see this all the time on comments back to us, which is, hey, you didn't like this market for a few years. We like what we like. I mean, we've got 58% in stocks. Rest of it we have in treasuries. But what I'm trying to say is when you get a lot of comments back that say, hey, don't worry about it. It'll fall off here in the short term. We'll be back at new highs in 6 months. I'll be back at new highs in 3 months. And here's why. COVID was a 5-week bear market. And then you get into 22 and it was a 9.5-month bear market. You go back to new highs. It's a drug. When you take it, it's like, I know we always go back to new highs. Well, sometimes you don't go back to new highs. I mean, you went from, oddly enough, 1929 to late 40s. I mean, you went all the way in the early 50s where you really made any money. And so people get confused on that sometimes. It depends on what's happening in the whole world. If you look at Microsoft is the oldest holding we have, 20 years. What happens is those kinds of companies get expensive. And if you look at those legacy stocks that we still have, like Alphabet, Google, Microsoft, a little bit of Apple, I think their best days are past. But those are real low cost basis for us. So we just keep taking them down and we don't buy those for new money. It's interesting. We see the market shifting to more stable type companies, if that makes sense, like dividend payers, stability. And we sense that as what's happening here. And they're getting away from the big 10 stocks. In all 3 strategies, 2 strategies, we own gold and the miners. 1 strategy, we just own the miners. That's in a stock strategy. So we like them, on a cash flow basis. All the miners are selling at cheap cash flow multiples. And now we've been in this group here for, 2 years. So it's not something new for us. And 2 of the strategies, we have about 4% in the bullion. So again, if you look at foreign governments, they're tired of putting all of their money in the dollar and in the treasury. So they're cutting that out and they're buying gold. Our market doesn't, central market, but theirs does. And that's where a lot of demand demand has come from. So I think you should probably, and I would look at gold as a side-by-side semi-currency relative to currencies, because a lot of countries want to back their currency with hard asset like a gold or something along that line. Again, I think you have to temper what you own. We're not going to have a whole portfolio, but we own some. The miner is cheap though as a company. All you have to do is go look at the cash flows. Here's the thing about Bitcoin. It's not a huge float. I mean, you have a few players control a lot of Bitcoin, and a lot of the Bitcoin holders that I see, this is empirical knowledge only, the people I talk to, but it seems like a lot of younger people have small pieces of Bitcoin. And if somebody asks me about Bitcoin and I have a chance to buy a company that will pay us a great dividend and pay as free cash flow, it's got a great brand that I can hold for the next 10 years and buy Bitcoin, I'm going to buy the company. Nothing against Bitcoin, by the way, but I think Bitcoin is a speculative item. And people say, well, no, it's a decentralized currency. Well, it's not, because it goes down too much when the markets go. It goes with the stock market. So you're not going to correlate a currency to the stock market. But you let the market fall 20%, and I can just about tell you for sure, Bitcoin will go right with it. And they've dropped a couple times over 60%. All I tell people, hey, we get that question quite a bit, is that, look, realize what you're doing. You're speculating, because you have to find a buyer more than you pay for it. That's your only way out here. Okay. If you know that and you know you're speculating, that's fine, because I don't think speculating is bad. It says you got to know what you're doing, and don't look at Bitcoin as quote unquote an investment that you want to hold on for 10 years, because I think there'll be a lot of ups and downs in it. I have to say, I don't have a clue as to what they're going to do, because I'm not certain they have a clue as to what they're going to do. The problem with that is this, is they'll tell you we're not a political animal. But if you notice what happened as soon as President Trump got elected, in this whole situation, they started talking down the fact that they may not have any more cuts. Either way, the 30-year bond price goes down and the yield goes up, either where they lower or raise. Here's why. If they lower rates, which they should not be doing now with this type of economy we have, you automatically push the money in, you automatically have more inflation. That hurts the bond market. If they raise rates, then you're getting in a situation to where you put pressure on the foreigners to sell bonds, because that raising those rates would be keep the dollar going, see? And then they're like, hey, I don't want any more of this. I'm going to take some of this debt down. And the way they would do it is sell treasuries and pay down to dollar denominated. I think they're caught either way. And I think that's what would really throw this Federal Reserve. I think they think, hey, we've got this under control. We've told you we got it all under control, but they don't have it.